Welcome, ladies and gentlemen, to Commodity TV and the new edition of our online interview presentation series. Today, we want to talk to Ryan King, the Senior Vice President Corporate Development of Calibre Mining. Ryan, good morning to Canada. How are you?
I'm excellent. Yeah, thanks very much, Johan. Thanks for having me on the show.
Yeah, perfect. Thanks for taking the time. Calibre Mining, you are a fantastic gold producer. Just took over Fiore Gold. I think that was a great move. And I'm a shareholder of the company. I have to say that in advance here, of course, for disclaimer reasons. And I would suggest, Ryan, we go directly into medias res, and the floor is yours. Please show us your company.
Okay, excellent. Thanks, Johan. And yeah, I as well, I'm a shareholder, as is a lot of our management team. We have a big ownership in the company. And even recently, we've been buying shares in the market. I've been buying in the market. Our CEO just bought 150,000 shares in the market. So really do believe in the product that we have, the opportunity in front of us, and really do believe in the gold environment right now because of all of the macro indicators that lead us to believe that gold is going higher. Mm-hmm. I'll just spend a couple seconds and maybe a couple minutes just giving the audience a little bit of background. Our team has been in the resource sector for decades. The two founders, the primary founders of the company, Doug Forrester and Blaine Johnson, have been in the resource sector for over 25, 30 years, putting together deals. In fact, the last deal that they structured was a company called New Market Gold. Mm-hmm. And some of you may remember New Market Gold was a very similar approach that we're taking with Calibre. We were a small publicly traded exploration company with aspirations to grow the company significantly and buy production. We did that with 3 assets in Australia and significantly invested back into those mines, reinvested into exploration, and we're fortunate to discover one of the highest grade underground gold mines in the world called Fosterville. We then financial engineered a deal to merge the company with Kirkland Lake Gold. And from there, the company went up 10 times on the back of that merger. So really what we're acting like shareholders when we put these companies together. And we are shareholders. And we want to see the best financial product grown out of what we're doing in terms of investing in the assets and doing financial transactions, like you just mentioned, Johan, to acquire more production and potentially very geologically rich ground to drill and discover new deposits. So that's a very similar approach that we're taking with Calibre. I'll make some forward-looking statements, as your audience, I'm sure, has seen these before. Mm-hmm. But just a little background and journey on Calibre is that, as I said, Calibre is a very similar story to our very successful past company called New Market Gold, which was acquired for $1 billion. Once it was acquired for $1 billion, it then went up, as I say, almost 10 times on the back of the merger with Kirkland Lake Gold to create a very superior financial product in the gold space. Calibre, in 2018, we restructured the company with a view to do a similar approach, go out and buy production. And fortunately, we were able to do that and partner with B2 Gold on their assets in Central America. So B2 Gold became a very big shareholder. We paid some cash and shares to B2, and we acquired the El Limon, La Libertad mines and mills, as well as the surrounding mineral concessions. And that's what started Calibre Mining in Q4 2019. We raised $100 million, largely on the back of the transaction I just mentioned on our new market success. People were very familiar with our team, our founders. And so they were willing to say, yeah, we like you guys. We know you know what you're doing. So we'll back you. So we raised $100 million, acquired the assets. But it's important to note that when we acquired the assets, there was Limon, a smaller mill, a 500,000 ton per annum mill. It was going to produce about 50 to 60,000 ounces a year for a number of years in front of us based on the resources it had in the ground. But the second asset, Libertad, a big mill, 2.2 million ton per annum capacity. B2 Gold installed that, built that in 2010. Spent over probably about $150 million putting that into production. But it was actually heading towards closure by the time we acquired it. And but we saw some opportunities in terms of exploration and potential. But it was really our CEO, Darren Hall, who spent over 25 years at Newmont optimizing assets around the planet. He's worked in Nevada, in Peru. He's worked in Indonesia, in Australia. So he's really got a very good understanding of operations, how to operate, but also how to optimize and reduce costs and increase production. And so he looked at the operating strategy, and from a new perspective, he said, well, we can haul material from Limon and process it over at Libertad. So rather than the mine going down into closure, or the mill going into closure, we started to haul material around using publicly paved highways, and that started to evolve. And shortly, we added another asset that was a smaller 300,000 ounce deposit called Pavon. And we brought that online and permitted it in less than 12 months and brought it into production for less than $15 million of capital, putting it through our Libertad Mill. Again, using the mill, mining and then hauling material to the mill. Mm-hmm. So in 2020, we produced 136,000 ounces. In 2021, which we just completed, 183,000 ounces of gold. And in 2022 here, this year, mm-hmm. we're guiding the market that we'll produce 180 to 190,000 ounces out of Nicaragua, out of Central America. And then, of course, as you mentioned, Johan, we just completed a deal to grow the business because we saw another unique undervalued opportunity in Fiore Gold, which is operating the Pan mine in Nevada. And they have a great development stage asset in Gold Rock, which is less than 15 kilometers away from Pan. Yeah. So we recognize that opportunity, but also the geological potential to grow the resource and reserve base there as well. And so when we factor in Pan, we'll do 220 to 235,000 ounces of production.
Ryan, short question, because I see here the all-in sustaining cost at $1,200 to $1,275. Do you see that significantly drop within the next, let's say, 1 or 2 years? Because you just mentioned, like Darren Hall is also somebody who is really fixed on to bring the costs down. Because I think this is also the key to raise the margin.
Oh, 100%. Yeah, we do. I mean, we've only owned the Fiore assets, of course, for a couple of months now, right? But we are looking at and recognize that there are some opportunities at Pan, particularly, where we could see lower costs throughout this year, even in light of the inflationary environment that we're in. So we are looking at ways to optimize that even now, but really over the next 12 months at Pan, particularly, it's going to require some drilling. Once we understand the scope and scale of what it is, then we can look at various things to optimize the costs, and I think it will have a pretty significant impact on those costs. But as well as with Central America, I think there's going to be opportunities, and I'll talk a little bit about the next couple of years, mm-hmm. maybe even now, because we see new assets coming online in 2022, 2023, and 2024, mm-hmm. which I think we'll keep our mining rates and milling rates at our process plants the same, but grade is going up. Mm-hmm. So grade is going up in the second half of this year, 23 and 24. So we're going to see grade-driven production increases, not mm-hmm. volume-related. Mm-hmm. What that means is that we should see a declining cost curve and an mm-hmm. increasing production profile overall, leading mm-hmm. to higher margins. So absolutely. I'm actually very excited about that.
And grade is king.
Well, and exactly. And so to that point, you see on the slide here, we're talking about a new mine called Pavon Central. Mm-hmm. This is a very high-grade open pit mine. So currently we operate what we call the Pavon Norte open pit. This is a 3-gram open pit ore body. However, Pavon Central is a 6.5-gram open pit ore body that we will be mining in 2023. Mm-hmm. So you can see a dramatic increase, or 100% increase in grade, and volumes will stay the same. Eastern Borosi is another development project, another mine we're developing, which we anticipate will be in production in the second half of 23, again lifting our grade profile, again leading to likely lower costs. So to your point, I know I elaborated there quite a bit, but yes, we do see over the next 12, 24 months a drop in all-in sustaining costs driven by grade.
Do you think you can bring it below the $1,000?
Well, we'll definitely try. It's hard to say at this point in time, given, here we are today, and oil is $105 a barrel, right? And we're seeing inflationary pressures, which is obviously very good for gold, but we're seeing inflationary pressures across the board, labor, consumables. So I think there's potential to get it pretty close. And particularly we'll have a much better idea halfway through this year, and potentially look at giving the market some guidance on or some forward-looking production guidance on 23, 24 to get a sense of that. And we'll know more, particularly when we give guidance for 2023, in terms of all the budgets, the consumable costs, et cetera, that are all required to produce over 200,000 ounces of gold a year.
Okay.
But the nice thing for us is, of course, we have a very clean balance sheet. So we've got $80 million in cash, and that's all been driven through operating cash flow and free cash flow. We have no debt. We're unhedged. And so you can see here we're investing back into the assets. This year we're going to spend $40 to $42 million and drill 170 kilometers of drilling between Nevada and Nicaragua. And that's all self-funded. So through our operations, we're going to self-fund our growth. We're going to self-fund our exploration programs, self-fund Pavon Central and Eastern Borosi. And I believe at these metal prices, we'll still be adding cash after investing a significant amount of dollars back into the assets to grow production. So I'll keep moving on here and talk a little bit about the valuation now. I mean, when we look at Calibre today, on an enterprise value to ounce of production basis, you can see that we trade at a significant discount to our peers. And these are peers that are, 100 to 200,000 ounce a year producers, between $1,100 and $1,300, $1,400 per ounce, all in sustaining costs. So I think this demonstrates a value opportunity. So you can see across the board here our consensus operating cash flow, our consensus production, and where we sit there. And then on the left-hand side, you can see on an EV per ounce production, we trade at a discount to peers. So
why do you think you are trading on that lower valuation? What's your personal feeling?
Well, anytime you go through an M&A transaction, there's shareholders that will stay, there's shareholders that will go, because Fiore was acquired, they were taken out, and that's what they wanted. And so we've been churning through some shares now for the last number of weeks and months, and I think that's partially due to that, the churn, if you will, of shares. So people have been selling, people have been buying, but those that we've been able to educate and talk to about the pro forma company, they go, oh, wow, this is a very interesting, compelling opportunity. And so I believe that partially it's that. I believe partially it has to do with, the environment that we're in is sometimes up and down. And now that we've only had the Fiore assets for 2 months, it takes some time to educate the market onto what we're doing. And they want to see a track record of delivering on commitments. And Calibre pre-Fiore had delivered quarter over quarter for 8 quarters. Now it's a kind of almost a bit of a reset. Show us what you can do with the Pan and the Gold Rock projects, and we start believing it.
Okay.
So I think it's largely that, but I do think it presents a very compelling opportunity.
Exactly. It's a nice buying opportunity, I would say.
I agree. And as I say, I mean, I've been buying in the market, as has our CEO, right? So we talked a little bit about this, right? We talked a little bit about what we've done in Nicaragua. And remember, one of the assets was heading towards closure. And now we're utilizing both of the assets, but we still have 1 million tons of surplus capacity at our Libertad Mill. So, that demonstrates to me that we have got potential for organic, low-cost growth. So already we're going to produce 180 to 190,000 ounces this year. We believe, and it's evident in the grade that we have in our reserves, that 23, 24, and 25, We'll see a grade-driven production increase over the next couple of years.
Mm-hmm.
And we're still only utilizing a portion of one of the mills. Limon, we use 100% of the mill.
Mm-hmm.
We haul excess material over to Libertad, basically debottlenecking that
Mm-hmm.
Limon mill. And then we can haul material all around and utilize that Libertad mill. So that creates a very unique organic growth opportunity.
Mm-hmm.
But quarter over quarter, we've delivered. We've now got 1 million ounces in reserves at 4.6 grams per ton gold. And I'll show a chart on the next slide. You can really see where we were in Q4 2019 to where we are today. It's a very significant 254% increase since acquiring the assets. And again, Darren and his foresight to invest back into the assets and the new operating strategy to unlock value for all shareholders.
Yes, and those are reserves. That's important.
That's 100% correct. That's the highest classification you can get, right?
Yeah, exactly.
So now we've got a very good platform and a cogent plan that are backed by reserves over the next 5 years. Then we look at Nevada now, right? So Nevada is very similar to, we believe, very similar to where Calibre was, say, in Q1 of 2020. So it does produce 40 to 45,000 ounces a year. However, as we've mentioned, a higher cost operator, producer at this point in time. So once we finish the programs that we're doing, we'll have a better understanding of the optimization opportunities to reduce costs and increase production. And the first thing we're doing here is doing 50,000 meters of drilling. So that drilling is underway right now. In fact, we just came out with a news release probably about a week ago, 10 days ago, which outlined expansion of resources. So we are finding new zones of resources there. We're converting lower category to higher category to reserves. And we'll continue to provide the market with drill result updates as they become available. And I'm pretty excited when you think about Pan, because over the last 4 years, on average at Pan, Fiore had been spending about $1 million to $1.5 million a year on exploration drilling at Pan. They were using their operating cash flow very efficiently. They were investing in a primary crusher to help liberate the gold. They invested in heap leach pad expansion. So they were doing the right things. But now with Calibre, we can unlock more value because we have a stronger financial position. We've got more production. We've got higher operating cash flows to reinvest back into the assets. And we can do it all at once. We don't have to pick and choose 1 or 2 a year, right? And so that presents a really compelling opportunity, because when we're done that drilling, we can then look at the asset and we can go, okay, let's go to owner-operated fleet versus contract mining, and maybe save ourselves 5 to 15%, right? So there's an opportunity. Look at conveyor stacking. Look at secondary crushing to help liberate the gold. All of these different things that Darren has identified and the team has identified to help us see what could be the cost savings and what could be the production profile going forward. And then there's Gold Rock, right? Gold Rock is a fantastic development stage project. We think it'll be another heap leach asset 15 kilometers away from Pan. And it's got multi-kilometers long of exploration potential that haven't been tested. So we're very excited. We're doing 35,000 meters, 35 kilometers of drilling there, advancing technical studies and advancing state permitting. So in fact, Nevada, we could see Nevada go from 40 to 50,000 ounces a year of production to 80 to 100,000 ounces of production as we advance Gold Rock.
Fantastic. I think Gold Rock has already like 2 million ounces of resources, if I'm correct.
Gold Rock is currently sitting at 500,000 ounces in all categories.
Okay. Yeah.
Yeah. So but we definitely see that type of potential, because this rock type and the structure that it's along, it's got a very prolific geological setting. What you might be thinking of is just north of us. Kinross has a mine there that currently has 2 million ounces in reserves. So yeah, it's along the same trend, and we think there's a lot of potential to expand, because there's areas that haven't been drilled and look like they're quite prospective. So very exciting exploration opportunity at Gold Rock as well, and a big land package, as you can see there. Collaboratively 220 square kilometer land package. I'm not going to go too much into detail. We've already talked about Nicaragua.
Yes.
But our new operating strategy, we're hauling material around, utilizing the hubs, right? The hubs are the mills. So here's the very large mill that we utilize at Libertad, and we only use about 60-70% of that mill. So there's still 1 million tons. That's 2 times the size of Limon, 2 times the size of Limon that we can process additional ores at Libertad. So any exploration success, any new discovery, you know, we can utilize the Libertad mill. We don't have to install $100 to $200 million new mill. We can advance the permitting. We can advance the project. And as we, in the case of Pavon, in less than 18 months, we put a new resource out. We permitted the project. We started construction, mining, and hauling within 18 months, utilizing the infrastructure that has already been built. So we're doing the same
super
thing.
fast.
Very fast. Yeah, very fast.
Oh.
Now, we're fortunate. There's a good mining legislation there, but we're fortunate because we have a very good team at Calibre that is very focused on community relations, sustainability, and we've got you know, we do huge amounts of public consultation, very transparent with the communities, and that's really key. Really key in Central America and most countries, actually. It doesn't matter where you operate, but we've got a good team that has laid a very good foundation. And I'll say that B2, prior to Calibre showing up and operating the assets, had laid a very good foundation of ESG and community relations for the assets. But this just presents the opportunity of utilizing the infrastructure, right? Utilizing this infrastructure accretively, and we still have room to grow beyond our grade increases over the next couple of years, and we have room to grow because we have over 1 million tons of excess capacity. I talked a little bit about this already, but just to reiterate, this is that chart I was mentioning. So you can see 2019, Calibre acquired the assets in Q4 of 2019. And you can see that the Limon reserves are a little over 200,000 ounces when we acquired the assets. So since acquiring the assets, we've grown reserves 254%. We're at the highest reserve grade these assets have ever had. And we've produced 350,000 ounces of gold. On the left-hand side, you can see that quarter over quarter, we're reinvesting back into these assets to have a sustainable business, to grow resources and reserves, but at the same time, we're growing our cash balance. So, you know, we will continually look at new accretive opportunities within the business, utilize our cash effectively, and make sure that it is all focused on driving a share price performance. And now we step back and look at exploration across the country. So Libertad, Limon, you can see the main operating centers there. The red concessions are concessions that we're exploring. The Bonavista concession has never been drilled or never been explored. It's the same size as the Limon concession. And Limon has produced over 3.7 million ounces of gold and currently has over 1 million ounces of resources and reserves at Limon alone. So this would be classified as a world-class low sulfidation epithermal district. This size between the past production, the current resources, over almost 5 million ounces of gold. So we believe along this belt, which we would call the Western Epithermal Gold Belt, we believe there's very good potential along this belt to find additional new deposits. And so we're excited to start exploring Bonavista. We're flying an airborne survey there, which will help us target and delineate new opportunities, new drill targets. And we'll start drilling in the second half of 2022 for the first time. So I'm very excited about that. And also all around Libertad, the concessions there, Amalia and Nispero, very good potential. What we're showing up here in the top right-hand side is our Eastern Borosi, or EBP project as well. So we've just converted a bunch of inferred material to reserves. So we've got over 220,000 ounces of reserves there now, and we're developing a mine there to put in a truck and haul down to the Libertad facility, like we do with Pavon and like we do with Limon, hauling material down to Libertad. We're currently running at about 1,000 tons a day that we bring from Limon to Libertad and Pavon to Libertad. Mm-hmm. So we've been very effective in doing that to increase production responsibly, methodically, employing locals. We think this is a great way to build our community relations and ambassadors for the project. So it's been a pretty exciting time. And when we step back, we've made a few new discoveries, but I think the brightest exploration potential is in front of us now. We've learned over the last 2 years the geological setting. We've got some new people on the team. And some of the last drill holes in 2021 at Libertad, at a new area, which we call Volcan. This is a shallow, high-grade open pit. And now we've found, looks like another ore shoot on this deposit. And the last hole was 15 grams over 5 meters. So we've got 2 rigs drilling there right now. And this is 5 kilometers from the mill.
Huh.
All of that material in this Volcan deposit was not included in those reserves or resources. Mm-hmm. It just, the drilling was too late to be included into the drill hole database for the 2021 update. So
it doesn't matter. Then do it the next time.
Yeah. No, and I'm excited because it looks like, so we've drilled about 1.5 kilometers of a 5 kilometer vein. So mapping on surface has identified the vein is about 5 kilometers long. So now we've got 2 rigs going up and down the vein system to see what the size potential is going to be. And again, 5 kilometers from the Libertad mill, and we have excess capacity. So I'm pretty excited about that. But overall, we've got 12 rigs operating in Nicaragua right now. Mm-hmm. So what I think our audience can expect is regular news flow of drill results updates. And in fact, we'll probably have one here within the next 2 weeks, an update probably centered around Pavon. That's where we've been getting results in from the lab. So, but throughout the year, we'll be providing regular updates on exploration. Mm-hmm. I talked about this already, but I just want to show the opportunity in front of us with the Libertad mill, right? And currently we're using the mill at about, let's call it about 50-60%, right? So if we're, you look at the grade in the column here, 3 grams, 4 grams, and 5 grams, mm-hmm. keeping in mind that our reserve grade is 4.6 grams per ton gold. And we're going to see a bump next year because of Pavon Central and because of Eastern Borosi. So we should start tracking closer to our reserve grade. Mm-hmm. Well, actually, in fact, if you look at the last couple of years, you'll see a trend of increasing grade consolidated across these assets, 2.7, 3 grams. And I think last year we averaged about 3.2. This year we're tracking for 3.2 to 3.5. So we're getting closer and closer because of mine sequencing and new mines being built to that reserve grade. Mm-hmm. So if we look at the utilization between 50 and 60%, even today at 4 grams, so between 130 and 160,000 ounces out of Libertad, utilizing more of the mill, up to 200,000 ounces at 4 grams. So this is really the torque and the low cost opportunity that we have in front of us. So this year, we'll produce between 125 and 135,000 ounces out of the Libertad facility. And, if we're successful with the drill bit or as we've mentioned, grade-driven production profiles next year, we're going to see higher productions out of Libertad. Mm-hmm. And, if we were to ever utilize the mill 100%, you can see the significant torque that this could bring. Now into the exciting stuff.
I thought it was already exciting.
Right? So now we move over to our second asset, our second jurisdiction, Nevada. And our goal at Calibre has always been to build a financial product backed by gold that outperforms our peers. And we're building that now, right? This is stage 2. Stage 1, acquire production. And we've optimized that production over the last 12 and 24 months. And you can see that. I mean, in Nicaragua, our guidance is $1,100 to $1,200 all-in sustaining costs, 180 to 190,000 ounces. Increases in production over the last couple of years, every year been going up. Now we look at Nevada as the next phase of opportunity to unlock value. tier one mining jurisdiction, as all of your audience I'm sure knows, producing asset. And so, as I mentioned at the front of the conversation, drilling at all of the resources and targets at Pan this year, 50 kilometers of drilling. This is going to give us a whole new data set of information to be able to understand how we can optimize the asset further than what it is today. So I'm really looking forward to the year in front of us here. As I've mentioned, we've already put out results that are expanding resources, and in some cases converting resources. And I think it's going to be an exciting year from a news flow perspective on the exploration.
Don't they have also another project? Because I think I mixed that up when I said those 2 million ounces. Golden Eagle called.
Yes.
This has 2 million ounces, right?
In Washington, yeah, that
in Washington State, yeah, exactly.
So we own that 100%. That's right.
Yeah.
It's and I think I've got a slide at the end of the presentation on that, which we'll talk about. But our focus right now has been Nevada, largely because of the stage of Pan being an operating mine, and we see some opportunity to reinvest back more capital into exploration, and then Gold Rock because it is federally permitted. Gold Rock is a federally permitted project. So the next phase would be going through the state permitting, which would, I envision or anticipate that we'll start that in the third quarter of this year, state permitting, and that is about an 18 to 24 month turnaround. We're doing technical studies on Gold Rock. We're drilling Gold Rock this year, so again, market will get updates on Gold Rock. And per Fiore's PEA, this Gold Rock would produce about 50 to 60,000 ounces a year at around $1,000 all-in sustaining costs an ounce, based on the PEA. We've got a lot of work to do in front of us, getting a better understanding from a business perspective so that we can deliver on the asset. But as it stands right now, it looks like a really attractive opportunity, hence the reason why we're investing into the asset to potentially double production out of Nevada.
Okay, super.
So I won't spend too much on this slide. This is a zoom in of Pan. I'm sure your audience has seen some of these typical plan maps. So the blue are the resources. The green are targets that we've identified, as has Fiore. Everybody at the operating site stays with the company. So all of the team there, Andy Brighton, the GM, all the process team, as well as Paul Nolan, they're the VP exploration for Nevada. And so it's finally, he's very excited to drill a lot of these targets that he hadn't been able to drill before now. So a bigger budget, new targets, lots of drilling. Currently, I think we've got 5 rigs operating in Nevada right now, which is no easy feat. It's hard to get rigs in Nevada right now, but fortunately, because of the size of Calibre, we've been able to go out to tender. We've now got a single source provider of drilling. So we're going to be going to a single source provider, which should help us on a unit cost basis. Some of these optimizations are already starting to come into the equation because of the pro forma size and balance sheet. But I'm pretty excited about that because there's all of these targets down to the south have never been drilled. Some of them have no drill holes at all into them, but have very rich geochem anomalies. So it's going to be exciting to get in there and drill and see what the resource potential is going to be.
Super.
Similarly with Gold Rock, as I mentioned, we'll be doing state permitting and technical studies. 35 kilometers of drilling will largely be focused on infill, a bit of step out to the north because Fiore did discover a new zone called Jasperoid Creek over 1.5 kilometers to the north outside of resources. And so we will be drilling in and around Jasperoid Creek where that star is in the top right-hand corner. We'll be following up on a couple of new targets as well this year. But first, we just really want to understand Gold Rock as it is today, break down the geological model, break down the block model, and advance the technical studies so that we can put together a plan and a project that we can deliver on and potentially put into production in the next couple of years. And we'd likely be able to do that through cash flow. So exciting times in Nevada and at Gold Rock. We've talked about we've talked a little bit about our production, our costs this year, our investments back into the business, and to your point, $1,200 to $1,275 all-in sustaining costs. I recall when we acquired the assets in Nicaragua back in Q4, we had a higher cost then. We've been able to take costs down. We've been feeling inflationary pressures across the business for everyone. much higher oil prices, therefore diesel, higher consumables. But I've got real faith in Darren as our CEO to optimize Pan, particularly optimize, and the team there has done a really good job on I'll call it a very small amount of budget. They've been operating it very well through their operating cash flow. So they've been investing based on smaller amounts of operating cash flow. Now we've got a much larger operating cash flow base that we can reinvest back into Pan and unlock value there and at Gold Rock. So yeah, I do think that the cost will probably come down over the next couple of years, all things being equal with inflation. And we should see a production increases over the next couple of years as well. But yeah, this gets us into Nevada. It diversifies the portfolio. And I think it's going to be an exciting year ahead for gold and for Calibre, particularly when we look at what we've been able to deliver in Central America for the last couple of years.
Yep.
And to your point, the 2 million ounce deposit in Washington.
Yep, that's what I meant.
Yeah. And you know, this is potentially a diamond in the rough, and it's 2 million ounces. Surrounding us is Hecla. To the north is Kinross. They've had a new discovery there. To the east is the Kinross's Kettle River Mill. So we're not doing too much on Gold Eagle this year. We will investigate it further, do some studies, understand it internally better. It does present a very compelling opportunity. And so I think that's where it stands right now, because our priority at the moment is Pan, Gold Rock, the producing assets. But we do think there's some really good potential here. As you say, it's a 2 million ounce deposit. And, so we may look at doing some work on this project later in the year after we do a bit more work on the asset. But it looks like some very good potential.
That's like a joker for the future.
Yeah. There you go. So this takes us to the end of the presentation. And I think it's really important to note for investors that since acquiring production in Nicaragua, Calibre has delivered quarter over quarter in terms of production, in terms of costs. We've increased production year over year through our operating strategy. We've significantly increased reserves to over 1 million ounces at the highest record grade ever seen. We've got a very strong balance sheet. We think on an enterprise value to ounce of production, we're trading at a discount to peers. And it's going to be an exciting year ahead with all the drilling that we have underway now. I think a total of 17 rigs operating across all the assets. So stay tuned. It's going to be lots of news flow, an exciting time for gold. It really is setting the stage for higher gold prices with what's happening in the macro landscape, i.e., debt, debasement of currencies, etc. It's unfortunate, but it is leading to a higher gold price, I think.
Yeah, definitely. That is for sure. Super. So that's it, Ryan?
That's what we've got. We've got a compelling story here.
That's for sure. Super.
Exciting stuff.
Thank you very much for the presentation. That looks really fantastic. I have one last question for you. When do you think you can start to pay dividends?
Good question. We've actually, it's funny you asked that, because we've actually gone out and spoken to some investors, some analysts, some bankers about capital allocation and returns to shareholders. And so this is definitely on our radar and trying to understand what is the best approach to drive share price performance. Okay. And, there's been interesting feedback on dividends. There's been interesting feedback on share buybacks. And of course, we're at a stage right now where we're a growth company. And so reinvesting back into the assets to help drive margin, help drive cash flow. And so it's definitely something we're investigating right now. Absolutely. Because you look at the Barricks of the world, the Newmonts of the world, they are giving dividends and paying dividends. And it's something that all companies need to really investigate to see what is going to be the best use of capital to drive your share price performance. And so we don't know yet. And at this stage of the company, it might be something for a little bit down the road once we have let's say 300,000 to 500,000 ounces a year of production, because that's our goal, is to get to 500,000 ounces of production, and deliver that organically, and may require another M&A transaction, in which we'd like to do, but we'll be patient about that.
Super, perfect. Ryan, thank you very much. Great story. I know why I'm a shareholder. You know why you are a shareholder. That's also for sure. And I think you've done everything right. Please keep on delivering.
We'll do everything we can. Head down and keep delivering. That's
super.
Key.
Okay, perfect. Thank you very much. All the best to you, and talk soon.
Talk soon. Thank you.
Yeah, ladies and gentlemen, that was Ryan King, the Senior Vice President Corporate Development of Calibre Mining. And I think Ryan, really the last 40 minutes, did a great job in explaining the company's story. And I think there's not really something to add. I know why I'm a shareholder, and I see the stock much, much higher. Even our price targets at the point and figure chart, they call for immediately $2.50 to $3 price targets. And I think they keep on delivering. That is for sure. The company has no debt. That's very important for me, as you know me. I don't like that. And also they are unhedged, so they can really benefit when the gold prices go to 2,200, 2,400, probably this year already. And I think organic growth is key to success. They do a great job on the path to 500,000 ounces production. So thanks for watching us. And I would really recommend you have a very, very close look onto Calibre Mining, and maybe you should own some stock. Thanks, and bye-bye from Switzerland.